Right now, the biggest banks in America are paying you 1/100th of 1% on your savings. Put $10,000 in a Chase or Wells Fargo savings account, leave it there a full year, and you'll earn about $1. Not 1%. $1. Meanwhile, that same bank can take your exact deposit and park it, completely risk-free, at the Federal Reserve, earning 3.65%. It can lend it out for much more. The dollar didn't change. Only who's collecting the interest on it did. That gap has a name, and it isn't an accident or an oversight. It's the product. So let's take apart the single most profitable machine in banking, the reason your savings account is one of the worst deals you'll ever quietly agree to. Here's the story we're all told. A bank is a safe place to keep your money. You hand it over, they guard it, and as a small thank you, they pay you a little interest on top. The savings account is framed as a favor, a gift for being responsible. But a bank is not a vault, and it is not doing you a favor. The moment your money lands, it stops being stored and starts being deployed. A bank is a machine for buying money cheap and renting it out dear. And the cheapest money it can possibly buy is the money sitting in your checking and savings account, because you're selling it to them for almost nothing. To see how little, you have to look at the two prices no bank puts side by side. There are really two prices for your deposit, and the gap between them is enormous. Price 1, what the big banks pay you. Chase and Wells Fargo, 0.01%. Bank of America, 0.04%. Across the whole country, the FDIC's national average savings rate is just 0.38%. And even that is inflated by better banks, because the giants pay a tiny fraction of it. Price 2, what your deposit is actually worth in the open market. Today, the top high-yield savings accounts pay around 4.10%, some listed as high as 4.5%. Same FDIC insurance, same dollar, same instant access. The only difference is which bank is holding it. So the real question isn't why does my bank pay so little? It's where does the difference go? Line the two numbers up. The bank pays you 0.01%. On that very same balance, it can earn 3.65% just by leaving the cash at the Federal Reserve overnight. No borrower, no risk, no effort. Lend it as a mortgage, a car loan, or a credit card balance, and it earns far more still. The bank keeps the difference. That difference has a name, the net interest margin, the spread between what a bank earns on your money and what it pays you for it. Across the entire US banking industry, that spread averages about 3.27%. It is, quite literally, the core of how a bank makes money. Put it in dollars. Your $10,000 earns you about $1 a year. The same $10,000, parked risk-free, earns the bank around $365. In a high-yield account, you'd have kept about $410 of that yourself. By staying put, you're handing roughly $400 a year, per $10,000, straight to the bank. The spread isn't a fee they charge you. It's a fee you never see. So where does your deposit actually go once it's inside? It climbs a ladder of interest rates, and you're standing on the bottom rung. The safest option, the bank hands your cash back to the government. It buys treasury bills, or simply leaves reserves at the Fed, collecting that 3.65% for taking essentially zero risk. One notch up, it writes mortgages and car loans at higher rates. At the top of the ladder sit credit cards, where the same deposits get lent back out at north of 20%. Here's the elegant, quiet part. The bank doesn't need to make a single risky loan to beat you. Even the most cautious, boring thing it can do, lend your money to the US government, pays it hundreds of times what it pays you. Your savings account is funding a business, and you've agreed to be its cheapest lender. Which raises the obvious question. If a better account is one click away, why doesn't everyone just move? And the answer is the real engine underneath all of this. It's you, or more precisely, your inertia. Bankers have a term for deposits that don't leave. Sticky. Your checking account has your direct deposit, your auto-pay bills, 15 years of habit, and the vague sense that switching is a hassle. So it stays. And because it stays, no matter how little it earns, the bank has no reason on earth to pay you more. A deposit that will never leave is the cheapest funding a bank can find. The loss is engineered to feel too small to chase. $400 a year, spread across 12 months, is $30-odd a month. Annoying, but never quite worth an afternoon of paperwork. Multiply that not worth it by 100 million customers, and you've built one of the most reliable profit streams in the entire economy. The banks aren't relying on your ignorance. They're relying on your friction. Now zoom out from your one account to the whole industry. In 2025, America's FDIC-insured banks reported net income of $295.6 billion, up more than 10% in a single year, which the FDIC itself credits to higher interest margins. That spread we've been talking about? It's the biggest single reason banks are as profitable as they are. Net interest income, the money made purely on the gap between what banks earn and what they pay depositors, runs into the hundreds of billions of dollars a year. It is the largest revenue line in American banking. And the raw ratio is almost comical. The best savings rate, 4.10%, against the big bank 0.01%, is a 410-to-1 gap. Same money, same insurance, same country. 410 times the yield, or 1/410th of it, depending on which side of the counter you're standing on. So if this is so lopsided, why does it survive in plain sight? Partly because it's legal and disclosed. The 0.01% is printed right there in a rate sheet almost no one reads. Partly because the big banks compete on branches, apps, and brand names, not on the savings rate, so there's no billboard screaming that you're being underpaid. And partly because the alternative already exists, and that's the honest catch. Online and high-yield banks pass much more of that rate back to you, precisely to win the deposits the giants take for granted. The 4.10% isn't a trick or a teaser. It's what your money is plainly worth when a bank actually has to compete for it. The system persists not because you can't escape it, but because most people never quite get around to it. So the next time you see that reassuring little balance and its penny of interest, remember what you're actually looking at. Not a favor, a price. The price you're being paid for the cheapest, stickiest, most valuable money a bank can get its hands on. The spread between your 0.01% and their 3.65% isn't a rounding error. It is the bank. None of this is advice on where to put your money. It's just the mechanics, so you can see the machine you're already inside. The interest is real. The insurance is real. But underneath the marble and the app, a savings account is a device for turning your patience into someone else's margin. And now you can see the shape of it. If you want the real mechanics behind the companies and products you take for granted, the numbers, verified, no hype, that's exactly what this channel is for. Subscribe, and we'll take apart another one.